as a starting point, I think we all have to recognise that 2008 truly was a terrible year for cross-asset returns. It's probably not as bad as what the Queen was feeling in 1992 when Charles and Di split and Andrew and Fergie went their separate ways and they had an internal barbecue at Windsor Palace. But nevertheless, you can see there that of the 10 asset classes that I've put up there, quite clearly we've got some pretty steep negative returns in LBTs and equities. But also, it all even spreads all the way out to residential property. Now, this next chart has a lot of numbers on it, but the general point that I'm trying to make out of this chart is down the bottom, the, let's call it brown, I guess, colour, is highlighting which asset classes are having their worst return on record as far back as you can really take reliable cross-asset returns. Really, the mid-80s is when we can get pretty reliable data on cross-asset returns. So you can see that 4 of the 10 looks like they're going to post their worst returns on record going back to that 25-year sort of horizon. And of course, again, no big surprise there, that even spreads all the way out to residential property. Now, there's a couple of points that we would make on this, of course. First of all, when you sort of look across the asset classes and index into a common starting base, you've given up 4 years' worth of returns in terms of LPTs. You've given up 2 years' worth of returns in terms of Aussie equities. And I guess the good news, though, and the silver lining, if you look back at history and you go back long enough, you can really generate a reasonably consistent picture that 1 year out from a sharp decline in Australian equities, you tend to find a very significant bounce. Now, in terms of this chart, we've just done this again since the mid-1980s, but you can see there that 1 year out, you tend to pick up around about a 28% bounce in equities the following year, on average. Now, although they've put a smile on some people's face, particularly those that are heavily geared up into equities, the longer-term picture is also reasonably encouraging though as well. This is taking back Australian equity performance back into the mid-1880s. And you can see from this chart that the periods of 2 negative returns from Aussie equities is, again, pretty rare. You really have to look at events of global significant scale in terms of economic depressions or recessions, or globally significant wars. Now, as Lewis mentioned, a lot of people aren't that pessimistic on the outlook for global growth, despite the fact that we all are obviously pessimistic about the outlook for the industrialised nations. I guess my view is, when we look at a chart like that, there is some cause for optimism. The probability of getting 2 consecutive years of negative returns in Aussie equities I actually think is quite low. And I'll take you through the rationale for that a little bit later. Before I get to it, though, I just want to give you my quick spin, my 2 minutes on how we got to the starting point of how we got such a bad year for cross-asset class performance. Look, I think it's reasonably quite straightforward in many ways. The chart to the right is just looking at excess savings in the developing world, and the bottom part of the chart is looking at the dis-saving done in the developed world. Now, some of these things are just on historically significant deviations. We don't really see those types of deviations any time really in the post-war period. And I guess the key point here, of course, is that the excess savings in the emerging world, which is now bigger than the developed world in terms of composition of global GDP, was truly significant. The chart to the left just brings it into a slightly different perspective. We're looking at foreign exchange reserves trends here. Now, even when Japan was really hitting its straps in the late 1980s, its foreign exchange reserves got up to something around about 15%. Of course, the BRIC nations there, if you add them all together, is just a truly phenomenal period of excess savings. Now, what did it do? Well, in conjunction, I think, with what Lewis mentioned there before, obviously low nominal real rates, or low nominal rates in the G7, but also negative rates, particularly in the G7 in the post-2000 period. It really is a story of Greenspan chasing Nauru down. Now, Lewis wanted to avoid technical terms. Well, the non-accelerating inflation rate of unemployment was a pretty hot term, I think, in the last few years of the 1990s. And in essence, Greenspan really wanted to see how far he could run the economy as inflation surprised on the downside. What we ended up doing, of course, is combined with this excess savings, trying to chase returns, and combined with very low interest rates, what we saw was an extreme event of bidding down of risk premium. Now, this chart is probably going to be pretty hard to see for those of you right at the back, but what in essence it shows is pretty much every major investment bank in the world, including our local banking franchises as well. And what we have on the chart is down the bottom part is 5-year average growth in assets, and on the y-axis is the leverage, assets over equity. Again, 5-year average. Now, you really don't want to be towards the top and to the top right of this chart, because you've basically been trying to grow too fast and you've been trying to do it basically on leverage. And I think when you look at this chart, it's no big surprise of where all the surprises have really come over the last 12 months. Every single company that's really had massive write-downs is really, you can see quite clearly, towards the top and towards the right. Our own local franchises are there to a degree, but even on that scale, Macquarie Bank is probably the one that's been most beaten up, the one that's been most vilified locally, with the exception of Babcock and Brown, obviously. But you can see that even on that scale, they weren't trying to grow their balance sheet anywhere near as fast as some of these other guys, and on much, much lower leverage. Our domestic banks are all congregated there on the bottom left-hand side. And again, you can make a case that perhaps their balance sheets had been growing faster than what they've done during comparable parts of the cycle, and leverage may well decline somewhat. But again, the amount of embedded greed that this chart shows you, I think, quite clearly, tells you that we'll have a long way to go in terms of bringing back towards acceptable levels of leverage in the global financial system. This chart is a very, very volatile looking chart, but it's the way that we look across our asset class volatility or risk premium. And I guess the point that we're just trying to make is similar to what Lewis was trying to make in terms of his golden age philosophy. It's really from that 2003 period through to the early part of 2007, volatility was remarkably benign. Obviously, we've had some shocks in the last 12 months which have been of global significance. You can see that the volatility of the upward line, obviously a movement up in this chart is a measure towards increased risk aversion. You can see 9/11 is there 1/3 of the way through. You can see the WorldCom experience, Iraq War. You can even go back to the long-term capital management. These last 4 or 5 shocks all happened in a pretty quick succession, but were of obviously global significant importance. So again, no big surprise that it was somewhat debilitating for asset class returns. I just want to digress quickly and put our spin on where we think global growth and inflation is going, because this is going to be the crucial point in trying to figure out what's going to happen next in terms of asset returns for 2008 and 2009. Look, I guess the view that Lewis put forward is pretty similar to our own in many respects. We'd have obviously a very weak industrialised or advanced nations growth coming through in 2008 and 2009. Unfortunately for investment markets, that's around about where 85% of all investable markets actually exist on the globe, so the fact that the BRICS are growing so strongly still makes it pretty tough for us as investors to get full exposure to that. But I think when you look forward there, we still have this view, and I guess I should put a caveat up front. We, I guess, as a house have been the most bearish on local economic growth for the last 18 months or 12 months or so, and we've had the highest inflation forecasts on the market. So you're kind of talking to one of the bears in the market. But when we look forward, you can see what's happened here is that, even in this chart, consensus has essentially come down to our growth forecasts. And that's pretty interesting because the RBA is now the other side of us. So we were pretty much are still the most bearish for growth on 2008, but your central bank has jumped the other side. That's very unusual, and I haven't seen that happen before in the last 15 odd years. The second point that we'd make is that most people now think the inflation has peaked, and so do we. We don't think it's going to come down quite as fast as what the consensus now thinks, but nevertheless, when we look at that chart, that's actually pretty interesting, because I know Lewis put up a chart on headline inflation. Core inflation has actually been relatively contained in most corners of the world. And it's really been a story about headline inflation, which is partly commodity prices. But even on this chart, you'd get a little bit more excited about riskier assets, because what we do know about periods when inflation is high is that riskier assets trade on much lower multiples. When inflation peaks and starts to move down, you get some multiple expansion again. We're at the very early phases of seeing this again. The financial markets certainly believe it. These are 2 charts just looking at basically the TIPS markets for the US and our own capital index bond market for Australia. So the red lines are inflation expectations. And you can see that quite clearly over the last month and a bit, there's been a huge shift, particularly, as you can see there, in terms of the Australian one, the one on the chart to the right. Again, it sort of coincides with the idea that inflation started to peak out. And when you look at the indicators that people have been following, it's pretty clear that one of them has been the idea that China is slowing. Now, if there was ever an indicator that probably got punched well above its weight in terms of its, I guess, underlying quality, it's probably the Chinese PMI data. But nevertheless, I haven't seen such an aggressive spruiking in the market of a data series that only goes back to start of 2005, as what we've seen in the last month or so. The general story here is that when you look across the indicator, you get a general picture that imports demand is slowing quite sharply, inventory levels are rising very sharply, and new orders have fallen off quite sharply. Now, I think you can take this one of two ways. You can take this as a story that commodity prices are going to remain in trouble for some time. We don't quite buy that, although we do think they're going to be in trouble for a couple of months. But I think the most positive thing you can take out of this is it's going to be a pretty important event for global inflation to the downside. China is carrying very large manufacturing inventories. We saw this at the end of 2004 and into 2005. The last time they had a liquidation of the inventory build. It actually turned out to be quite a disinflationary event for the next 6 months or so. I think we're about to see something similar over the next 6 months or so. And I'd also caution you, if you're still fearful about inflation trends, to just bear in mind that although we are very much of the camp of the super cycle for commodities, we are seeing commodity price trends roll over. Now, to get ongoing inflation, you need commodity prices to continue to go up at a similar rate every year. That we don't think is likely. The very virtue that Lewis put up in terms of that business investment chart and the fact that 50% of it is indeed in mining investment tells you the supply response is coming incrementally, even locally. That similar chart can be seen in Canada, Latin America, even parts of Asia. The supply is coming, and we're seeing, more importantly, demand destruction at the level of commodity prices as they currently stood. So you can see here, even on the agriculture front, wheat prices, dairy prices have clearly rolled over, both very significant drivers of inflation locally. Base metal prices obviously rolled over, both in $8 terms, but more obviously in terms of US dollar terms. Again, going to help out in terms of those PPI charts that Lewis put up. Real oil prices have clearly peaked. Well, we of a house are of the view that oil prices are going to hold about or move back up to about $140 a barrel, actually. But again, it's the rate of change that matters. It's the 12 months performance in terms of oil prices. And even if they hold at $140 a barrel, by around about mid-part of next year, the change will be flat. The big one has been bulk commodity prices, coal and iron ore expectations. Now, as many of you have probably detected in the last month, there's been a huge shift in sentiment on this front. Steel is no longer seen as the place to be in terms of many Asian investments, and we're seeing the spot prices for coal and iron ore come off quite sharply. At the moment, our forecasts actually embed the idea that iron ore prices go up again next year. And I would say that if our resource strategist is getting a little bit nervous, he's been getting more nervous over the last few days or the last few weeks. And it would be that category, I think, that would be the one that would be perhaps most at risk. And of course, steel prices are huge in terms of what they do in terms of inflationary expectations and prices through the global system. So where does it leave us on interest rates? If we think inflation is peaking, and we think we can clearly detect, as Lewis mentioned, particularly in the developed world, output gaps are opening up, labour market you're finding, spare capacity. We do think that rates in most places are on hold, if not falling. These are just the futures curves, and the thick lines on these charts represent our forecasts for the various cash rates around the world. One on the left is the Fed funds rate. Wherever the view the Fed is finished, if anything, I think there is a bias that they would be cutting. The change that we saw over the weekend in terms of Freddie Mac and Fannie Mae, which was on that earlier chart, by the way, is actually globally significant as well. It probably takes out the expectation that the Fed is going to have to do something over the near term as well in terms of near-term rate direction. So we're pretty happy with the idea the Fed's on hold over the course of the forecast period there, which is the end of 2009. Euroland, my bias is they'll be cutting, not raising rates. I know on our forecast here we have our European economists saying they're going to remain on hold. Again, the fall-off in demand indicators is quite precipitous, and I think we'll see a shift in bias there in coming months. Japan, we notionally have rate hikes in there. I think for the last 5 years we've had rate hikes in Japan. In terms of our official forecast, they just tend to get pushed out a little bit every 12 months or so. I fully expect, with Japan's basically on the cusp of recession again, the fact that we'll be getting interest rates rises in Japan over the next 12 months I see is highly unlikely. And in terms of Great Britain, as Lewis mentioned, the UK is in all sorts of trouble at the moment, and the bias there will certainly be for low interest rates. Locally, well, we've been, I guess, as I mentioned, we've been really pretty bearish on growth, so no big surprise we actually thought rate cuts were coming. Chart to the left is the Interbank bank futures, and I just noticed the label's gone off the top there, so apologies about that. The shaded area is what the futures market's actually pricing for rate cuts at the moment. Now, we have 125 basis points of cuts in mind through the course of this cycle. I think Lewis is actually 100% right. The RBA won't be too aggressive in the first half of 2009, though. And that's mainly because we're also detecting a huge shift in bias in terms of fiscal policy. Now, bear in mind that the current year is actually quite contractionary for fiscal policy. Economists can cut and dice data in all different ways. But I think the most reliable way of thinking about federal fiscal policy at the moment is you look at spending decisions as a percent of GDP. They stripped about 0.7% of growth out of the 08-09 data of GDP, that is. So it's quite a significant contractionary period. They have enormous fiscal resources. They have $79 billion up their sleeve over the next 4 years. If they want to hit their 1% of underlying cash surplus over the period, which is probably not appropriate if you're in a downswing anyway, it's still about 3% of GDP up their sleeve that they can push through. And they do obviously have additional tax cuts in mind for 1 July 09, which were already factored in. But of course, I think there's going to be much more than that. So we're actually quite bullish on the fiscal stance as well. The chart to the right is actually quite an important chart for us. As an economist, I rely on financial conditions quite significantly. And you can also get a sense of why I've been pretty bearish over the last 12 months, because it tends to lead growth in the non-farm economy by about 12 months. Now, we had to put this chart together before the GDP data came out, but the blue line there is non-farm GDP, which obviously came down to about 2.5%, basically in line with what the Financial Conditions Index was forecasting. But it's actually suggesting growth will slow to about 1% of GDP year on year, 12 months out, if there's not a shift in policy. 1% of GDP year on year is not an acceptable rate of growth, I think, that the RBA would have in mind. If they cut by 125 basis points and even the currency goes down another 10% from here, it'll take us to where the dot is, which is about 2.75% of year-on-year economic growth. That's where I think they have in mind. That's what will be required in terms of both interest rate cuts and probably currency weakness to put us back on a sub-trend growth that is still going to allow capacity to build through the economy, but something that would actually be seen quite favourably by equity markets and riskier assets. The other thing to bear in mind that we put up a chart earlier on about what happens after a negative year in equities. This is just looking at a chart what happens across the asset classes after the commencements of an interest rate cutting cycle. So 3 bars on the chart. The first bar looks at what happens 6 months after the commencement. The second bar looks at what happens 12 months. Third bar, 18 months. Now, if you were brave, you'd be loading up in LPTs. I'm not particularly going to suggest that you do that. There is obviously a massive asset overhang out there that will have to be realised. Cap rates are obviously rising, which is the additional concern there. But beyond that, it really leaves Aussie equities and offshore equities as the 2 most favourable places to be. And in essence, when we get to the conclusion, that is really where I think the places where you should be starting to think about shifting portfolios. Now, again, this is just basically the way that we go about calculating this equity risk premia and credit risk premia and basically across the asset classes. It's very much the way an economist would do it rather than what a portfolio manager would do it. In essence, we're looking at potential rates of earnings, so where we are through the cycle in terms of our rates of earnings, and look at movements in terms of dividend yields and bond movements to try and back out where the risk premia is evolving through time. I won't necessarily go into the technicalities of it, but I will show you graphically how they look. And pretty much no matter which country you do this on, This is how the equity risk premium actually looks at the moment. It's sitting right up there at historical highs. So unless you believe that potential or through-the-cycle earnings is materially lower, then you certainly can't take the view that equities are expensive. Now, even when if we took Australian potential GDP down below 2% and hold it there, it would still leave equity risk premium at the top of that one standard deviation move, which is the purple bar at the top there. So they're cheap, regardless of how you look at it. If we look at it versus a similar sort of exercise and start substituting in other asset classes, we can do this via commodities, we can do this via credit. I'm not convinced that credit's overly cheap at the moment. It's certainly still within its sort of fair value band, but I don't think it's overly cheap. And for commodities, as an asset class, and we're using the Goldman Sachs commodity index, they've actually come from something that looked actually very attractive over the last 6 months or so to something that looks broadly fair value, with some negative sentiment overriding the asset class over the next couple of months. So I think this is an asset class that's going to hit cheap, and it's going to hit cheap probably by calendar year end. So again, if I had to put a bias, this is something that's probably second cab off the rank, but it's going to be a little after a few months. Now, if we sort of back this out a little bit and do it the way the most portfolio managers would look at things and look at prospective earnings, what the analysts are actually forecasting and back that out relative to bonds, again, equities look undervalued. Now, they're not quite as undervalued as what they were in February, March 2003, but we're not that far off it on a relative basis. If we look at it on the basis of absolutes, so forward PE multiples. Now, again, I should highlight, I think I can go back. Yeah, I can. We tend to look at things ex resources. We do that quite deliberately, and we also try and strip out the financials in some of these charts. And we really are interested in what the core underlying industrials earnings growth is in the Australian equity market. So they're pretty cheap on a relative basis, as I mentioned. In this case, we're looking at the industrials, so there's ex-banks and ex-resources. Again, as cheap there as I've been since '95 on that basis. And these are based on our analyst earnings, but we've really tried to take the hammer to our analysts. It's part of my job to go around and trying to get them to smash down their earnings estimates. So on average, we're a little bit below where the broader consensus sits for the underlying earnings growth. If you look at the resources, well, they really haven't been this cheap since the early 1990s. And I think this is the standout. Again, I said they're going to get cheap on a relative basis to bonds, but I think we're already there anyway in terms of absolute PEs, and obviously the underlying earnings streams are truly phenomenal. So it's been something of a puzzle, I guess, for our resource strategist as he sits there and looks at the earnings and wonders why people aren't loving resources at the moment. But again, everyone is still trading macro themes, and as soon as we get some confidence that this industrial shutdown in China is largely past, I think you won't find the underlying support, which again is not too far away from where Lewis sort of put the line in the sand. We think around about November, December is when you'll see people actually becoming a bit more interested in this sector. Another thing to bear in mind, this is sort of a chart that we use to get some sort of assistance as to when is the appropriate time to buy equities as well. And we're looking at this really from an underlying cash yield basis. So what we do is we gross up the dividend yield in the Australian equity market. So we're allowing for the franking credits, and we look at that relative to the underlying cash rate. Now, whenever we tend to get around about where we are right at the moment, it tends to be a pretty good time to step back into equities. Now, of course, if the RBA is cutting rates through the course of 2009, this equation is just going to get better and better. So obviously the underlying yield support there is actually quite supportive. And there may be elements of the equity market that you have some fears over in terms of whether the yield is sustainable. But I don't think we're going to see a wholesale step down in the underlying yield structure. And again, these are prospective yields that we're using. So our analysts have tried to take into account where the yields have actually already been cut. This table is probably quite important because, as I mentioned, I've been quite bearish on growth, and we've been quite conservative in the way that we've structured our portfolios in regards to equities over the last 12 months. But I think when you try and back out what the equity market is currently pricing, it is actually pricing a recession. When we look back at the last couple of recessions and what happens to earnings growth in Australia during recessions, the 83 and the 90s, we tend to fall 15-20% in terms of EPS growth. And we tend to trade down on quite low multiples. This chart is telling us that right at the moment, with the index sitting around about just a little under 5,000, it's factoring in around about a negative 12.5%, negative 15% EPS growth, and it's doing it on a forward multiple of about 11 times. That's pretty conservative, and I think there is some genuine value there. The trick is when to step up. And again, I think the bias is going to be that you'll get an additional couple of interest rate cuts by the end of this calendar year. But what I think is interesting is that we've had this convergence or resetting of growth expectations locally, and I think we're getting that globally as well. We're finding a bit of a base. And although Lewis Wrotson points out that some of these key things about US house prices and the like are going to be quite important, I would stress to you that US house prices have stopped falling as fast as what they at an annualised and seasonally adjusted rate. They're now falling at under 10% a year. And we're starting to see, obviously, the shift in the policy framework. This Fannie Mae, Freddie Mac deal over the weekend is incredibly important. So not only can we start to get a realistic price of what the underlying securities are worth by house prices stabilising somewhat, we're actually getting the underwriting, I guess, by the US taxpayer. Again, two pretty fundamentally supportive things for riskier assets as we move forward, again, because it's come post the resetting of expectations. This is how my growth forecasts look, I guess, and you can see there that, again, we've had to do this ahead of the national accounts, so it's non-farm GDP, so we came reasonably close for non-farm GDP, big deal. The idea is that looking forward, this is really where we think the profile is going to look. And again, it's partly based on the way that we see the shift in policy bias, that financial conditions chart, if you cast your mind back to it, it's not dissimilar for how we see growth picking up by the end of 2009. And I would caution that the growth really isn't going to come through in a year-on-year sense until the end of 2009. But if equity markets are looking forward, they should be starting to move back, I think, through the first quarter of 2009 in terms of looking at the growth prospects. There's also, I would put the caveat on it as well, we're also thinking that if the $8 has come off so much, around about a 2.5 cent in the Australian TWI fall is equivalent to a 25 basis point rate cut anyway. So you've already had a big shift in broader financial conditions. And secondly, as I mentioned, the fiscal stimulus that we think is coming is going to be quite dramatic. You've had Swan actually say the words, we think we're going to have to recalibrate fiscal policy. And I think he means that in a very understated way. We're not through the worst of it, though. There is a big squeeze on discretionary spending. The chart to the left is the way that we construct the variable called discretionary cash flow, where we try to take into account what's going on, obviously, in terms of essential spending items, so rents and petrol and all that stuff, food. But we also try and take into account what's going on in terms of broader credit growth. And I do think that the consumer is still going to slow. There is going to be ample reason for the RBA to try and provide some support on this front. And again, the real pickup here doesn't come until the back half of 2009. So I wouldn't be expecting much by way of growth in the very near term. I think we'll also start to see those sentiment indicators finding a base. And I think this will be one of the things that will help out riskier assets is the idea that we're no longer seeing the marked step down in deterioration in broader sentiment indicators. We've seen it in New Zealand, we've seen it in the US, we'll see it here in coming months as well, particularly as the shifting rate expectations and oil price falls come through. The two most requested charts from the hedge fund community globally, from us, I reckon locally, are these two charts because they try and look at where basically assets to liability ratios sit. Chart to the left is just total liabilities, a percent of GDP. The US and the UK and Australia are all on the one chart. Chart to the right is trying to put debt servicing obligations on the same basis, so how much you have to pay given relative rates. And again, they kind of love these charts because they assume that Australia is going to play out in a very similar manner. I don't assume Australia is going to play out in a very similar manner, and the main difference has been that the overvaluation of house prices probably aren't as excessive as what a lot of people currently assume them to be. I think this is the fairest way of valuing house prices. It's sort of a CAPM model for house prices, for those of you that like CAPM type approaches. But it tells us that over the last year or so, we've seen some convergence anyway. They're probably about 15% overvalued on this metric. And I think and there is a lag, by the way the data is collated. We've probably seen bigger house price declines than what's been reported anyway, so the valuation gap could even be narrower. And of course, when you look forward, we have this phenomenal undersupply of established housing as the backdrop. I'm being very conservative in the way I put this chart together. we do quite a bit of work on underlying demand for housing, and I'm using some very, very conservative assumptions. This could be the biggest undersupply of established housing in Australia you'll ever see. And that is going to be broadly supportive for underlying house valuations as we move forward. So the tsunami that's going to come through that a lot of people are talking about, and we're going to see house prices declining in Australia, and the unwind of household balance sheets, and therefore much subdued demand through 2009, I just don't think is going to happen. What we are going to see is a sub-potential growth environment, but and marked against that a big shift in interest rate expectations. Just want to shift a little bit to our view on the Aussie dollar. I guess for the A-dollar, we've been trying to argue for several years that there's going to be an asymmetric step down. This incremental rise, it doesn't feel that incremental, I guess, for many people, but it was actually a reasonably incremental rise in the A-dollar. Our thesis had been that, yes, terms of trade hadn't gone away. It was actually quite a significant driver of why the A-dollar had stepped up. But it's important to bear in mind that there are other forces going on in the background. And the big one is that there was pretty much what you guys do. When you allocate money offshore, it's still largely unhedged. And when you back out what the unhedged capital flow out of Australia has been and chart that relative to the underlying rise in the terms of trade, it's been a hugely offsetting aspect. And empirically, it works very well. So the way that we view things moving forward is that if the forward-looking aspect of the terms of trade is that it's rolling over, or that it's going to hold at high levels but flat, you'll certainly lose that catalyst. But we're not yet detecting that people's appetite to send assets offshore in an unhedged basis, or largely unhedged basis, has diminished at all. You put that in conjunction with a resetting of rate expectations, that rates are coming down. You put that in conjunction with a resetting of growth expectations, that growth is coming down. And I think you can build the case why the A-dollar actually holds at pretty low. Our 12-month forecast a month ago, we thought we were being brave. We had it at 80 cents. It feels, on Friday afternoon, it felt like it was, we're already there. As you're probably aware, the A-dollar's gapped up 3 cents in a very short time over the weekend. But I think the bias is going to be that we actually move down towards that 80-cent level over the course of the next 12 months. Part of the reason is that the longer-term anchors are still that on a PPP basis we should be down around 70-odd cents over the medium term, and it's really only that commodity price normalisation that is stopping us from getting there anyway. So that's ultimately where we're going to head. So on a medium-term investment view, that is still the way I would structure portfolios. I would still be putting allocation offshore and riding the A-dollar down. I still think that's going to be a reasonable, advantageous place to be. And it doesn't matter where we put these PPP charts. We can do this on any currency. We can do it against the renminbi, we can do it against the pound, whatever. They're all over. The A-dollar is overvalued on all those bases. Last thing, I mentioned we use another thing called a monetary model, which is essentially just relative growth expectations as a driver for the currency. And this is meant to be the workhorse of international finance for the last 30 years. Trouble is, people just couldn't get this to work for the US and Euroland, so everyone forgot about it. But it works really well for the A-dollar. It's essentially just relative growth, so Australia vis-a-vis US economic growth, if you like, over relative money supply growth. And our thesis here is that the US is going for a double-dip recession. If you look at the data, it actually almost got a recession in the early part of 08 now. They revised it down. You had a negative quarter. You'll probably get further downgrades as we go. First half of next year, we think the US is going to be flatline in terms of its annualised growth rate. That certainly is not going to help, but we're also stepping down in terms of our growth rate, and we're seeing that obviously come through. And I think that this gives us some confidence the A-dollar is not going to rebound aggressively, particularly as we see other parts of the world slow as well. So where are we? Well, in a broad-based sense, this is where this is what we're recommending for investors on a 12-month view locally. We're doing this relative to what we see as benchmark. Obviously, everyone will have different benchmarks, and you'll have different asset classes that you invest in anyway. But in essence, we believe the bonds are not only fairly valued, they've actually gone the other side of fair value in many nations, including Australia. We think equities are vastly undervalued. And we have that bias, as I mentioned, that the A-dollar is more likely to go down on a 12-month view than to go higher. So we're still quite interested in international equities as well. In terms of some of the other ones, We're still underweight property, despite the fact that I've showed you that LPTs do move higher over the course of the cycle. I am very wary about the asset overhang, and I do think that's going to be a hard ask this time around. So it may well miss out somewhat through this economic cycle. And in essence, we are still carrying a little bit of extra cash right at the moment, but we're really just holding out on the basis of our belief that equity markets, as they recover through the course of 2009, we want something to actually allocate further back into it. That is, in essence, the way I see the asset markets moving. There's a whole series of tables. I'm not sure if you get the presentation sent to you electronically, but our forecasts as they currently stand are on this slide, but I'm not going to torture you and take you through it line by line. The one thing I would highlight to you, though, is that growth in business investment that Lewis put up, it's technically impossible to get a 34% rise in business investment next year. It would require a 10% rise in business investment every quarter. And the best that we've ever had, going back to the 1950s, is a 4% rise any quarter. And that came off when the business investment as a ratio of GDP was actually quite low. This is coming off when the business investment ratio of GDP is actually at cyclical highs. So it's going to certainly maintain the cycle. It's certainly going to be a good offset. We're not going to see the fall off that we've seen in previous down phases for global growth and for profits. But it certainly won't be adding to growth as much as what those expectation surveys suggest.